Let's start the session. So today we are going to discuss about bank reconciliation statement. Okay. So yesterday you asked me, Dad, please teach me bank reconciliation statement. Okay. So the moment when you asked me to teach bank reconciliation statement, so I was thinking through my mind an easy process or easy method to explain you this rather difficult topic. For a beginner like you in accounting, okay, so bank reconciliation statement is a bit complicated. Okay, so therefore I was thinking through my mind how I can teach you an easy way, easy method, so that you can easily understand, easily absorb the concept. Okay, so that it will be not difficult for you to understand the topic, the subject. Okay, this is what I was thinking. Okay, so now I thought, so while thinking I thought, okay, I will explain you this by way of a story. You understand? So I am going to tell you a story now. What is the story? It is a story between two accountants. Okay, for this example purpose, let's assume, there are two accountants. Okay, so one accountant is from Sam company. Okay, this is Sam company accountant, and the other accountant is in the bank, in a bank. So let's assume the bank as commercial bank. The bank name is commercial bank and they have an accountant. Is that clear? Okay. Now story begins like this. The owners of Sam company, okay, so they invested 5,000 US dollars. Okay, the moment the accountant, okay, the moment the owners invest money in the bank, in the company, what he has to do, the accountant, what he has to do?
Record the transaction.
He has to record the transaction. So how he will record the transaction? He has to open up two accounts. So what is the account?
Cash book.
Yeah, he has to open a cash book and the other account should be equity account. Okay, so this is the equity account, this is the cash book. Okay, so let's assume 1st January he invested 5,000 US dollars. So he will debit the cash book and he will credit the equity account 5,000. 1st January cash. So this is the beginning of the story. Owners have invested 5,000 US dollars in the bank, in the business. This is the investment. Okay. Now the story continues like this. The owners decided to open up an account with the bank to do transaction with the suppliers and the customers. Okay, so the owners have decided to deposit 3,000 US dollars in the bank. Okay, from the point of view of Sam company, the accountant, what he has to do, what he will do, how he will record the transaction?
He will credit cash and debit bank.
Bank, okay, so that you need to open up a bank column, isn't it? Okay, so we'll open up these two columns. One is for cash, the other is for bank. So this is the bank column and this is the cash column. Bank column and cash column. Clear? Okay. So what is the transaction? How much he has deposited? 3,000. So when you deposit 3,000, how he will record in the cash book?
Credit cash.
Yeah, he has to credit cash. Where he will debit?
Bank.
Yes, because the cash reduces, bank balance increases. Okay, so let's say 5th January, bank, and 5th January cash, he will debit the bank column 3,000 and he credited cash column 3,000. So these kind of transactions are known as contra. Okay, so you have to put contra entry. Is that clear? So this is one part of the story. Okay, now when you take the cash 3,000, will he have the physical cash with the accountant, Sam Company's accountant? He will not have. Okay, so for the sake of recording the transaction, what he will do, he will credit the cash and he will debit the bank column, but he will not have physical cash. Now what he has to do? Now we are moving on to the other story. What is the other story?
Commercial bank account.
Yeah, commercial bank account story. Now in order to do transaction with a bank, the company has to open up an account with the bank. There are two types of accounts you can open: savings account and current account. For the time being, we will discuss these two. Okay, we are going to discuss about the current account. Why current account? Why we have to open up a current account?
To put in the cash.
Yeah, so when you open up a current account with a bank, they will issue a checkbook.
Oh.
When you have the checkbook, okay, you can do transactions with your suppliers, customers. You understand? So therefore, to have a checkbook to do transactions, you have to open up a current account. So he has to physically go to the bank. Somebody has to physically go to the bank and you have to open up a current account. Okay, so he goes and deposits. Let's say you have fulfilled all the requirements. What are the requirements? You have to fill up an application form. You have to submit the company registration forms, company signatories. All those documents will have to be submitted to open up a bank account. Okay, let's say you have fulfilled those requirements. So he deposits the cash. The moment the accountant of the commercial bank receives the cash from the from Sam Company, what he has to do, what he will do. Now you have to think the story from the point of view of the commercial bank. Okay, commercial bank accountant, what he will do the moment he receives cash?
He will record the transaction.
Where he will record the transaction?
In the cash book.
Yeah, he receives cash. So therefore, the commercial bank will maintain a cash book. Okay, that cash book. This is cash book of what? Commercial bank, no? They will deposit, they will debit that account 5th January and where they will credit?
In a separate account.
Separate account. What is the separate account? What is the name of that account?
Sam's Company.
Yeah. This is why Sam's Company?
Because it's a liability.
Yeah. Very good. Okay. Because when you debit one account, the other account has to be credited. That is a double entry concept. So commercial bank accountant, he will debit the cash book of the central commercial bank account and he has to credit somewhere. What is that account? Where he should credit? Sam Company account. He will credit 3,000 5th January cash. Yes, Sam. Okay. Now, from the point of view of commercial bank, from the point of view of the bank, whenever they receive cash, okay, it's a liability for them. They don't own this money. Okay, they keep this money on behalf of different customers. Okay, as far as SAM company is concerned, it's a customer for commercial bank. Okay, they don't own this money. Okay, whenever they come and ask for money, they have to pay back. So therefore, they will show this as a liability. Is that clear? Okay, now we are learning the first concept. What is the first concept? From the point of view of the SAM company accountant, when he deposits money in the bank, he will debit his cash book, the bank column of the cash book. However, when the money is deposited in the bank, the commercial bank accountant, he will credit the SAM company account because it's a liability towards them. Whereas when the SAM company deposits money, it reduces one asset, it increases another asset. So therefore you have to increase the bank balance. Is that clear, that first concept? Okay. Now this story continues. What is the story? Okay. SAM company has purchased goods on credit. Let's say $500 worth of goods they purchased on credit. So when you purchase on credit $500 US, the accountant of SAM company, how he will record in the books of accounts?
Purchasers debit.
I will erase this part.
The supplier's account you will credit.
You have to credit, no? So you will debit. He has to debit the purchaser's account and he has to credit what? The supplier's account, no? It's a credit purchases. Let's assume it's 500. So let's say 6th January, the supplier, and 6th January purchases. Clear? Okay. This is a credit transaction. Now he has to pay. He has to pay off this liability, supplier. Okay. Now he is going to issue a check. He is going to settle this money by way of a check. Okay. Now let's say 10th January, supplier. Okay. Now he issues a check, 500. So when you issue a check, you need to credit the bank account. Balance reduces, no? And you debit the supplier's account. Is that clear? Okay. This is the bank column. This is the supplier, 500. So thereby, you are setting off your total liability. Okay. Now, when the accountant issues a check worth 500 to the supplier, what will happen? Now, the check is with the supplier. Okay. Now, the supplier, what he will do, what he has to do, he has to go to the bank, our bank. Okay. He will go to the bank. And he will go and he will present the check. These are very important. These words are very important. Okay. So what he will do? He will present the check in order to encash it, in order to get cash from the bank. Okay. The moment he presents the check, what will happen? He will get the cash. Okay. From the point of view of the commercial bank accountant, what he will do, what he has to do. He receives a check. He will check from where he has received the check. This check was issued by Sam Company. Okay, so whether they have money, yes, they deposited 3,000. Now they want 500 to be issued to a supplier. Yes, but money is there, so they will simply release the cash to the supplier. How he will do? What he has to do? The accountant of commercial bank
should credit.
So they will credit the cash book, no? 500. And they will debit Sam Company. Why? They have a liability of 3,000. Now,
it's decreasing.
Yeah, they are just releasing their liability. Okay? So it's getting reduced, their liability. Okay? So this was issued on 10th, let's say 10th January. 10th January. Cash was released to Sam Company's supplier. Is that clear? Okay, now we are going to learn the second concept in this topic. So what is the second concept? The moment the Sam Company accountant issues a check, what he does, he simply credit the bank column. However, when this check goes to the bank accountant, what he will do? He simply debits our account because he is just releasing our liability. The liability is getting reduced. You understand? Now, that's why he is debiting. However, the Sam Company accountant, he credits the bank account because our balance is reducing. Our asset value, our bank balance is getting reduced here. However, from the bank point of view, the bank liability is getting reduced. You should know the difference. Okay? Now, after all these transactions, what will happen? At the end of the month, the company will receive a statement called bank statement. You understand? So, how does it look like, the bank statement? I'll show you that. Okay? So, I will erase this part. The bank statement will look like this. Okay? So, this is the bank statement. Bank statement. It will say as at 31st, let's say January 2020 at the end of the month. So it will indicate the company name, Sam Company, with the address and all, the date, description, debit, credit, and the balance. These are typical bank statement will look like. This is how a typical bank statement will look like. Okay? So, the 5th January, we went and deposited, no? To show deposits. 3,000. Balance is how much? 3,000. Then, 10th January, they have issued a check to supplier. Then check number will be there. How much? 500. Balance is how much? 2,500. So the moment the accountant of Sam Company receives this bank statement, what he has to do? Even the Sam Company accountant will have to close their books of accounts at the end of the month. So after closing the books, you need to transfer the closing balances to the next month. This is a process, accounting process. So practically, this is what's happening. Okay. So the moment he receives this, he will compare with his cash book. You understand? He has to compare. So what are the differences between these two accounts? Bank statement and the cash book. So this comparison, this process is known as what? Reconciliation. We are reconciling the bank statement balance, the transactions with the cash book transactions to identify the differences, whether the transactions that we have recorded in our books are in fact recorded in the bank statement as well. If there are differences, we need to identify that. Okay. Now, what he will do? So he has to check the debit side of the transactions with the credit side of the bank statement. Is that clear? Why we are comparing the debit side and the credit side of the bank statement? It's clear, no? That's what I explained. Because from bank point of view, they look at the transaction in a different angle. Because from bank point of view, when money is deposited, it's a liability. However, for the company, it's an asset. So therefore, you need to compare the debit side of the bank column with the credit side of the bank statement. This is the first concept. Is that clear? Okay. Secondly, he has to compare the credit side of the bank column with the debit side of the bank statement. Okay. So he will compare credit side and the debit side of the bank statement. Why? So when he issues the check, the asset balance getting reduced. When banks release the check, their liability is getting reduced. Okay. So therefore, the moment you check the bank statement, if we have a credit balance, which means we should have a debit balance in the cash book. Okay. So this comparison, this cross-checking is known as a reconciliation process. Is that clear? Okay. So just to recap, what do you know about bank reconciliation? What does it mean? Bank reconciliation mean, what does it mean?
Bank reconciliation statement is issued by the bank to cross-check with the company's bank column or bank account with the bank's bank statement to identify if there are any
differences or any mismatching transactions has taken place. Okay, so bank reconciliation means it's a reconciliation or a comparison between bank statement and the bank column of the cash book, just to identify any differences, any deviations, any matching transaction has taken place. Just to see these differences, we prepare a reconciliation statement. Okay, so when you prepare the reconciliation, what you should do? You should compare the debit side of the cash book, debit side of the bank column in the cash book should be compared with
the
credit side of the bank statement. Understand? Then the credit side of the cash book in the bank column should be compared with debit side of the bank statement. If you can understand this concept, it's very easy. This is what you should know about the reconciliation process. You understand? Okay. Now we'll move on to the second chapter of the story. So this is the first chapter. What is the first chapter? We just learned about what is a reconciliation. How do you do a reconciliation? You understand? So this is what we studied in our first chapter. In the second chapter, I am going to make this story little bit complicated. You understand? So that you will be able to understand this particular topic. Okay, just take down.